In 1987, the RJR Nabisco conglomerate established a sprawling corporate headquarters complex in Cobb County, Georgia. Driven by CEO F. Ross Johnson, the $50 million facility was a monument to corporate luxury, featuring an executive chef, a dedicated art curator, a boardroom table that cost $150,000, and a fleet of corporate jets known simply as the RJR Air Force. But this unchecked spending was about to trigger an unprecedented financial war. It set the stage for a staggering $31 billion leveraged buyout, a deal so massive it remained the largest of its kind in history for 17 years.
Financial historians often point to the RJR Nabisco buyout as the absolute peak of 1980s Wall Street excess. But a deal of this scale didn't happen in a vacuum. It was mechanically possible only because of a newly popularized financial engine: high-yield, high-risk debt, championed by Michael Milken at the investment bank Drexel Burnham Lambert. These so-called junk bonds allowed buyers to borrow enormous sums of money against the future cash flow of the very company they were purchasing, transforming the landscape of corporate America and empowering private equity firms to target corporate giants.
The catalyst arrived on October 19, 1988. F. Ross Johnson, backed by the investment bank Shearson Lehman Hutton, proposed taking his own company private. He offered $75 per share in a management buyout, effectively putting the entire conglomerate in play. Wall Street noticed immediately. Just 5 days later, on October 24th, the private equity firm Kohlberg Kravis Roberts, or KKR, led by Henry Kravis and George Roberts, entered the contest with a tender offer of $90 per share. The bidding war had officially begun, and it would ultimately result in Johnson losing control of the empire he had built.
The stakes escalated rapidly as rival factions dug in. By November 1st, an attempt to forge a joint bid truce between KKR and Johnson's management group collapsed completely. Investment bankers and lawyers crowded into the Plaza Hotel in New York City, staging intense negotiations, while competitors scrambled to submit alternative bids. The sheer volume of debt required to win the company alarmed even seasoned dealmakers. Ted Forstman, co-founder of the private equity firm Forstman Little, publicly condemned the reliance on junk bonds to fund the massive transaction. On the record, Forstman dismissed the high-yield financing as funny money. The frenzy reached its climax on November 29th, when the RJR Nabisco Board's special committee, headed by Charles Hugel, set a final deadline for sealed bids. On December 1st, the board reached a unanimous, highly controversial decision. They chose KKR's proposal over the management group's offer. What made this remarkable was the price. KKR offered $109 per share, nominally lower than Johnson's bid of $112 per share. But according to the board's financial advisors from Lazard Frères and Dillon Reed, Johnson's proposed securities lacked value guarantees and contained less actual equity. Furthermore, the board firmly rejected the massive personal compensation package Johnson had designed for himself, effectively handing the victory to KKR. The final deal structure was staggering. RJR Nabisco was valued at roughly $25 billion in equity, or about $31 billion including assumed debt, burdening the newly privatized company with an 87% debt load. Ross Johnson lost control of the conglomerate, but he did not walk away empty-handed. His final severance package was valued at roughly $53 million. For the company itself, the consequences were severe. To service the crushing interest payments on KKR's debt, RJR Nabisco was forced into a massive contraction. Over the next 6 years, the company slashed 46,000 jobs and sold off $6.2 billion in corporate assets.
The shockwaves of the buyout reached far beyond the thousands of employees who lost their livelihoods. The massive debt load instantly downgraded RJR Nabisco's existing high-grade corporate bonds to junk status. In response, Metropolitan Life Insurance Company and Jefferson Pilot Life Insurance sued RJR Nabisco,
claiming the leveraged buyout violated an implied duty to existing bondholders. But federal courts ruled against the insurers, determining that companies have no unwritten covenant restricting their own debt expansion. That single legal defeat forever altered corporate finance. It forced Wall Street to adapt, prompting the creation of modern event risk covenants, known as poison puts, in bond contracts. The battle for RJR Nabisco didn't just end an era of unchecked executive luxury. It rewrote the rules of corporate debt, leaving a permanent scar on the American financial system.